Good day, my name is Dean Crocker and I'll be taking you through our latest EI report completed on Bank of America Corp. On the 15th of April 2021, Bank of America released its first quarter results for the full year 2021. This was for the 3 months ended March 2021. The results reflected the following. Net interest income declined by 16% to 10.3 billion, whilst non-interest income increased by 90% to 12.6 billion. The overall impact was revenue of 22.8 billion. Efficiency ratio, however, worsened from 59% to 68%, and this was on the back of a 14.8% increase in operating expenses. Pre-provisioning operating income did, however, fall 21.5% to 7.3 billion, reflecting the increase in operating expenses. Noticeably, there was an improvement in credit with a credit impairment release of 1.9 billion, resulting in an improvement in the allowance for loan and lease losses, which decreased from 2.04% to 1.8%. This is for the period of the fourth quarter 2020 versus the first quarter 2021. In terms of the balance sheet, total deposits increased by 5% to 1.9 trillion. The Tier 1 capital ratio remained relatively strong at 13.3% despite decreasing from 13.5%. There was an improvement in the Tier 1 leverage ratio where it declined from 7.4% to 7.2%. The return on average assets had a nice improvement from 0.78% to an improved value of 1.13%. And this was also seen as an improvement in return on common equity, which increased from 8.39% to 12%. The full year 20 segments reflected the following. There was a decrease in consumer banking of 49%. Global wealth and investment management also declined by 27.6%. And global banking also ended 57% lower. Global markets, however, showed the only increase or improvement of 50% to 5.3 billion. And the other segments reported a decline as well, but an actual improvement in the loss. In terms of the impact, on the date of release, the share price closed 2.8% lower relative to the Dow Jones, which closed 1.33% higher. This therefore reflected that there was quite a negative sentiment towards the results release. In terms of the relative performance of Bank of America versus the Dow Jones, since the start of 2021, Bank of America has already outperformed the Dow Jones by 20.8%, with a year-to-date outperformance of 29.9%. However, on a 2 and 3 year period, Bank of America has underperformed the Dow Jones. In terms of valuation on a price-to-book value, the group now trades at a 31.4% premium to its 5-year average of 1 times, and a 3.3% premium to its FactSet peers. On a multiples valuation basis, the group screens fairly valued. A further 2.7 billion release in credit provision was seen, which should benefit the results, that also results in more normalized return on equity. In terms of the assessment, the results released by Bank of America really do reflect subdued economic conditions that we experienced in the US market. It's noticeable to show that there was a real low interest rate environment, combined with significantly higher credit loss impairment ratios. We are seeing that the provisioning models were probably too conservative in nature, resulting in over-provisions. And subsequently, you've seen the significant releases coming through in a lot of the financial sectors. Bank of America in the past 2 quarters has shown a release in the provisions. This would thus start to see a normalization of the return on equity, but also support the earnings releases in the coming periods. You must be mindful of this, as it is, there should be a normalization that return on equity back to normalized levels, which could be and most likely is the reason for the significant outperformance in the beginning stages of this year relative to the Dow Jones. It would appear that the low-hanging fruit has been picked, leaving now just with the more sound underlying conditions. So just in terms of the release of the credit loss provisions, 46 improvement in earnings per share to 86 cents. This is quarter on quarter. Another return on common equity at 12.3%, with a low efficiency ratio of 68%, which is year on year. In terms of the asset base, it grew by 5% to 2.97 trillion, so just $3 trillion, with total deposits increasing 5%. Total revenue remained relatively unchanged at 22.8 billion. Whilst operating expenses, however, did increase on the back of all the COVID-19 expenses by 14.8% to 15.5 billion. As mentioned, the provision for credit losses saw a release of 1.9 billion following that 2.7 total release. The credit loss provisions ratio therefore improved to 1.8%, whilst the net charge-off ratio was about 0.37%. The common shareholder equity increased to 249.7 billion, whilst the return on common equity was at 12.28%. Tangible book value saw an increase of 1.4% to 209 cents per share. So Bank of America's equity base has remained relatively sound and stable. The Tier 1 capital ratio, despite declining marginally from 13.5% to 13.3%, but there was a nice improvement in the Tier 1 leverage ratios, declining to 7.2%. Total assets grew 5% to 2.9 trillion, whilst the net loans and leases only accounts for 29.8% relative to historically higher numbers. This is really largely due to the fact that net loans and advances would have been impacted by the higher provisioning numbers taken through the balance sheet. So with the release coming through in this last period and the last two periods, we do expect that there'll be a normalization in the capital allocation in terms of the balance sheet. The balance sheet does always seem relatively lazy, with a significant proportion of the assets sitting in cash, federal funds and debt securities. That balance is sitting at 48.6%. So Bank of America really has the ability then to move around assets within the balance sheet towards riskier assets should they wish to take on greater risk but at higher returns. It will be seen in the coming periods how they manage that. In terms of the dividends per share, that increased by 9% to 72 and the dividend yield of 2%. Return on equity has steadily improved over the past few years, as seen in the graph. And on the back of all of this, given that the low-hanging fruit really has already been picked, the environment remains relatively subdued. We have seen a significant improvement in economic conditions within the US, far ahead that of expectations, resulting in a real correction in the equity market back to almost pre-COVID levels. However, the inflation concerns remains and the interest rates have remained low. So Bank of America will definitely benefit from higher inflation and higher interest rates. But as it currently stands, we feel the share is fairly valued across the board. And on that basis, we have provided a neutral recommendation on the share. If you wish to place a trade, please speak to your financial advisor. Alternatively, you can place it with the trading desk. Just take note of the disclaimer for benefit of all. And have a great day.